Another week in the books, and this Friday morning the entry gate is open. Welcome to the VIXShield Daily Market Summary, Morning Outlook for Friday, April 17th, 2026. These signals and insights are for educational purposes only and are not financial advice. Trading involves substantial risk of loss. You can lose more than your initial investment. No live trade execution, signals only. Past performance is not indicative of future results. Here is what we are covering this morning. A place signal heading into the final session of the week. A VIX that has been quietly cooling all week. A broader market that just crossed a significant milestone, and a few Fed voices still on the calendar that could shake things up before the closing bell. Let's walk through it. The S&P 500 closed Thursday at 7,041. Let that number sit for a moment. 7,000. We crossed that threshold and the headlines confirmed it. The S&P 500 topped 7,000 for the first time. That is not a small thing. Milestone levels carry psychological weight in markets, and this one has been on traders' radars for weeks. The CBOE Volatility Index, the VIX, settled Thursday at 17.69. That is down from 19.12 the day before, a drop of roughly 7.5% in a single session. The 5-day moving average on the VIX sights at 18.53, and our current reading is running about 4.5% below that average. When the VIX falls below its own recent trend line, that is a signal the market is exhaling. Tension is easing. And for income traders who sell options premium, that direction matters. The VIX term structure is in what we call strong contango. Here is what that means in plain language. The 3-month forward volatility reading, known as the VXV, is sitting at 20.77, while the near-term VIX is at 17.69. That spread is just over 3 points. Contango simply means the market expects more uncertainty further out than it does right now. It is the calm, normal state of things, and for iron Condor traders, it is a favorable environment. Premium tends to be well priced, and the near-term range expectations are contained. Across other asset classes, the picture is worth noting as we head into Friday. The US dollar index moved lower by about 1/3% Thursday, which typically loosens financial conditions and supports risk appetite. Bitcoin gained over 2%. Ethereum was essentially flat, up a fraction. Gold climbed more than 2%. That is a notable move, and we will come back to it in a moment. And crude oil, down sharply, more than 12%. That is not a rounding error. That kind of move in energy has ripple effects across inflation expectations and sector positioning. Now let's talk about what drove all of this, because the headlines this week told a layered story. The banner headline Thursday was the S&P 500 crossing 7,000 and the Nasdaq touching 24,000. Tesla surged more than 7.5%, leading the charge in large cap technology. When a single name like that moves that aggressively, it tends to pull index level implied volatility lower, which is exactly what we saw in the VIX drop. And behind that headline sits a more complicated picture. The Federal Reserve is in an uncomfortable position right now. Multiple outlets are framing it the same way. The Fed is stuck. Inflation risk on one side, slowing growth on the other. That is the classic policy trap. Raise rates, and you choke the economy. Cut rates, and you risk reigniting price pressures. The Cato Institute weighed in on monetary policy this week, and the broader debate around Fed independence and rate path is very much alive heading into the weekend. Which brings me to something directly relevant to today's session. We have two Fed speakers on the calendar, Governor Waller and President Barkin. These are the kinds of appearances that can move the VIX meaningfully in either direction. If either speaker signals concern about inflation persistence, expect volatility to tick back up. If the tone is more measured, the current calm may hold through the close. Meanwhile, gold's 2% gain. Thursday is worth a separate thought. Gold does not typically surge alongside equities unless something underneath is creating demand for safety. The macro case for gold right now, uncertainty around trade policy, Fed positioning, and dollar direction, is real. It is not panic buying, but it is a signal that not every investor is fully convinced this rally has clear air above it. And that tension, equities climbing, gold climbing, crude collapsing, the Fed stuck. That is the weak story in a single sentence. It is a market that is moving higher, but doing so with one eye on the exit. Now let's look beneath the surface at volatility, because that is where the discipline lives. The VIX at 17.69 puts us in what we call the caution zone, between 15 and 20. Not alarming, not complacent. It is the range where careful traders stay active but stay measured. The decline from yesterday's 19.12 is meaningful. That is a 7.5% single session drop in implied volatility, and it moved us firmly below the 5-day average of 18.53. Realized volatility, what the market has actually been doing over the past 10 trading days, is running at 12%. Compare that to the VIX at nearly 18, and you see a gap. Implied volatility is priced about 50% above what the market has actually delivered recently. For premium sellers, that gap is the opportunity. You are collecting premium based on fear that has not materialized in actual price movement. The expected daily range indicator, our EDR, came in this morning at 1.38%. Our entry threshold is 1.5%. We are comfortably below that line. EDR gate met. Both conditions satisfied. The signal is place. Now, the strategy insight for today. Here is what had to be true for this morning's place signal to trigger. The VIX had to be at or below 20. Check. We are at 17.69. The expected daily range had to be below 1.5%. Check. We are at 1.38. Both gates open. That is not always the case. This week, we have earned this signal. VIX at 17.69. Elevated but still below 20. Conservative tier is green. Safe to place. Balanced is yellow. Tradable, but size down if you are cautious. Aggressive is red today. Blocked per our VIX rules. We do not push the aggressive button when volatility is running this hot. For educational reference, the conservative iron condor structure this morning looks like this. The put spread anchored near 68.95 and 6900 on the downside. The call spread near 71.80 and 71.85 on the upside. Net credit of 65 cents per contract. Maximum loss of $435. A risk-to-reward ratio of 6.7 to 1. The balance structure tightens that range slightly. Put side near 69.25 and 69.30. Call side near 71.50 and 71.55, with a credit of $1.10 and a maximum loss of $390. The theta time shift is in forward mode this morning, with the EDR temporal reading at over 8%, well above the threshold of just under 1%, and the VIX above 16. The signal is to extend duration to 7 days to expiration. The reason, at this volatility level, you capture more vega, the premium sensitivity to volatility, by giving the trade a little more runway. Estimated vega capture in the 45 to 80 cents per contract range. On the protection side, the ALVH, our Adaptive Layered Volatility Hedge, has 2 of its 3 layers active this morning. The short-term spike guard and the medium-term VIXShield are both running. The long-term endurance hedge is currently inactive given the contango regime. That is appropriate positioning for this environment. Step back for a moment and consider what this week looked like from beginning to end. We came into Monday with elevated volatility and questions about whether the market could sustain momentum. Through the week, the VIX drifted lower, the S&P climbed through 7,000, and by Friday morning we are sitting at a clean place signal with 2 of 3 tiers active. That is a constructive week. Not without risk. The Fed is still in the room. Gold is signaling caution, and crude's collapse is a wild card for energy and inflation, but constructive. The discipline lesson this Friday is simple. The signal does not care what day of the week it is. The rules either say place or they say hold. This morning they said place, and the job is to respect that without overreaching. Conservative and balanced are available. Aggressive is not. That line exists for a reason. Going into today's session, watch the Fed speakers closely. Governor Waller and President Barkin are both on the calendar. Any hawkish tone could push the VIX back above 18 or 19 quickly. Watch whether the S&P can hold above 7,000. That level will attract attention in both directions. And watch crude. A continued collapse there could start feeding into broader risk sentiment by afternoon. Over the weekend, monitor any geopolitical developments and Sunday evening futures when they open. That first futures tick. Sunday night often tells you more about Monday's mood than anything else. If you found today's summary valuable, share it with a friend. Both of you will receive 14 extra days of free trial access to the full VIXShield podcast and signals. Your personal share link is waiting for you in your member dashboard. This market summary is brought to you by VIXShield, your protection against daily uncertainty. Trade well today. Respect the tiers. Let the rules do the work. That is what they are there for. VIXShield signals are for educational and informational purposes only. This content does not constitute investment advice, a solicitation, or a recommendation to buy or sell any security. Options trading involves significant risk and is not suitable for all investors. Past performance is not indicative of future results. Always consult a licensed financial advisor before making investment decisions. This morning outlook is prepared for educational purposes only. Market conditions change rapidly. All data reflects the most recent available information as of collection time. Do not trade solely based on this content. This is VIXShield, your daily protection against market uncertainty.